Coming up on Market to Market. Hurricane-force winds slash across the Midwest, leaving millions of damaged acres behind. A look at how the Federal Reserve takes the economic temperature of the grain belt. And market analysis with Mark Gold and Ted Seifert next.
For the big three as a whole.
What's the most complex industry on Earth? It's not genetics, or meteorology, or logistics. It's a business that involves them all. It's farming. Thank you, farmers, from Pioneer.
Sukkot Manufacturing Company, providing equipment and buildings to store and condition grain to help farmers adjust to market swings. We build drying, moving, and storage equipment designed to preserve the quality of their crops. Sukkot Manufacturing, store now, profit later.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
This is the Friday, August 14 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Paul Yeager. We are almost to the midpoint of hurricane season. And this week, a storm with winds equivalent to a Category 2 storm ripped across the Corn Belt. Initially, more than 1.2 million people lost power across 6 states. 4 days after the storm, more than 250,000 customers were still without electricity. The human death toll was 22 people, and the damage to property and crops will be in the billions. John Torpy has our coverage.
Corn farmers across the Hawkeye State are assessing the damage after a storm packing triple-digit wind speeds laid waste to this year's crop. On Monday, a derecho, or straight-line windstorm, leveled what was expected to be a record crop with winds topping 100 miles per hour. Early estimates from state officials show up to 10 million acres have been impacted by the rare weather event. Described as a hurricane without an eye, the storm did most of its damage in Iowa, wiping out millions of acres of corn and soybeans. Neighboring states Nebraska, Illinois, Indiana, Wisconsin, and Michigan were all impacted along the storm's 770-mile journey. As of Friday morning, 25 counties have been declared disaster areas by Iowa Governor Kim Reynolds. Vice President Mike Pence visited Iowa later in the week as cleanup was well underway. For many farmers, cleanup begins with one hand tied behind their backs as trade wars and the global pandemic continue to weigh down rural America.
In the near term, we have to decide, do we keep this crop for grain, or do we try to get some forage value out of it, either as a green chop, feeding it fresh, to livestock, or do we try to ensile it for cattle down the road? And that decision is going to have to be made relatively quick.
According to the latest USDA World Agricultural Supply and Demand Estimates report, the 2020 corn crop, if realized, will come in at just over 15 billion bushels. Government officials are still trying to pinpoint exactly what kind of impact this week's storm might have on final crop numbers.
But just trying to think through number of acres of corn that were affected and percent yield loss and trying to average things out. We could be in that 150 million or more bushels, of total production that come up short this year. That will be a big thing.
For Market to Market, I'm John Torpy.
The U.S. Senate joined the House on their planned summer vacation this week after hitting an impasse over the next coronavirus relief package. Millions of Americans waiting on Congress were left with unanswered questions as some sectors of the economy picked up steam. The Consumer Price Index rose 0.6% in July on higher gas prices, which AAA says averaged $2.18 per gallon. Without food and fuel, core CPI moved the same 0.6% higher. Retail sales added to its 3-month stretch of recovery, increasing 1.2%. Without sales of autos and gas, the rate moved 1.5% higher. The economic figures that we quote nearly every week are part of what the Federal Reserve is watching when it decides economic policy. I had a chance to speak with Nathan Kaufman, lead economist for the Kansas City Federal Reserve Bank's Omaha office. We started our discussion with the large grain supply's impact on the economy as a whole.
Yeah, so agriculture has a lot of linkages in this region, even if it's not farming directly, that plays into the economy, because manufacturing is tied to agriculture and transportation is tied to agriculture. And there's a number of communities that would be tied very closely to ag and banking. So the indirect effects of what happens in agriculture do spill over into the rest of the economy. In April, I would say, again, at the peak of the crisis, we worried a lot about sort of what the health of the industry might be. This was a time when ethanol plants were closing quite dramatically. Meat packing plants were closing because of COVID disruptions. Trade was a real question. The last couple of months, we've seen some of those things improve a little bit, and there have been some government support programs that I think have allowed some amount of relief to be able to offset the challenges. To your point, though, about low commodity prices, this is an environment that ag has found itself in really for the past 5 years or so, or more in some places. So while I think that there may be support that allows producers and the industry at large to get through 2020, I think going into 2021, those large supplies are likely to continue to weigh on prices and profits into next year, which is almost certain to affect then how producers will need to make decisions and how the industry positions itself going forward.
We've also had government programs that have allowed stimulus money to come in the form of MFP 1 and 2. However, I guess this is more of a political question, but not a political question, but you're going to take it that way anyway. Given the presidential election, I mean, some of that has to play into how do you factor looking forward the politics, just like it would be the weather, two things unpredictable that we know influence an economy, but you can't really quantify on what it does for the economy.
Yeah, so I think that when we try to get our assessment of what the markets might look like, we would certainly want to look at those fundamentals of supply and demand and take into account what's happening globally and trade flows and things that we know on the basis of data, but then recognize where there might be sources of uncertainty. And we may describe those as, you know, potential factors that are upside risks or things that would also be risks to the downside. So I think that we try to describe those that way, but it would be very difficult to try to forecast on the basis of potential policy, or even for a lender for that matter, to make a decision on financing on the basis of what programs might look like in 2021. And so I think where we've found ourselves at the beginning of each of the past 3 years, in advance of some of the programs that you referenced, is to say that the markets look like they could be a challenge again, and there could be more financial stress. But in each of those years, there has been some sort of program then that has mitigated or offset some of the weaknesses that we probably would have observed without them. So that's sort of how we go about our discussion of the conditions, but recognizing that there's going to be risks to either side.
Never a dull moment for you, is it?
And certainly not in 2020.
All right, what's the rest of the day like? What are you going to read? What's something that folks should be looking at to kind of help better understand what you're looking at?
Yeah, you know, we obviously follow markets on a regular basis, but we're also paying attention to things that are broader than that. You know, pricing, not just from commodities, but even on the retail side of things, and tracking what's happening in terms of consumer behavior. This massive shift to consumption at grocery stores and supermarkets has big implications for what happens on the farms and producers from a raw material perspective. So, you know, we try to pay attention to all of those data points. We try to interact with as many people as we can. Like I said, we're coming off of a couple of weeks of a policy meeting, and now sort of starts the time leading into September where we are reaching out and formulating our questions that we want to understand going into our next FOMC meeting and policy cycle. So, you know, even having these sorts of conversations and taking questions from people, those are things that we will do quite regularly so that we have a better sense of how to think about the pulse of the industry in the region.
I always like a good question. What was one of the questions from last month?
So we've been trying to understand the impact of the pandemic on supply chains and supply chain disruptions. And so we will ask whether it's our contacts in the region or a specific industry, to what extent they may be experiencing challenges in the supply chain and how that might be factoring into any sorts of pricing pressures. So is it difficult getting materials of a certain kind, for example, if you're a manufacturer, or in terms of commercial real estate, what does that market look like, and are there disruptions there that we should be thinking about, and pricing pressures? So we've asked a lot recently about the health and strength of our supply chains, and it goes back to my comment about the shift in consumption to supermarkets as opposed to restaurants. And that holds a lot of, I think, importance for what happens in the broader economy in terms of how those supply chains might be holding up, both here and globally, because we do focus also on what supply chains look like across borders, here in China and other places.
Next, the Market to Market report.
A bearish WASDE report was offset by the increased damage reports from Monday's storm. For the week, September wheat gained a nickel while the nearby corn contract jumped 17 cents. Soybeans rallied on FSA acreage reports and sales to China. The September soybean contract improved 31 cents. September soybean meal expanded $9.80 per ton. December cotton grew 49 cents per hundredweight. In the dairy parlor, September Class 3 milk futures increased 63 cents. To the livestock sector now, October cattle gained $3.78, September feeders climbed $1.45, and the October lean hog contract added $2.05. In the currency markets, the U.S. dollar index lost 32 ticks. September crude oil gained 73 cents per barrel. COMEX gold fell 90.90 per ounce, and the Goldman Sachs commodity index expanded 580 to finish at 349.75. Joining us now to give us some insight are two of our regular market analysts, Mark Gold and Ted Seifert. Gentlemen, good to see you both.
Good to see you, Paul.
Good to see you, Paul. How's it going?
It's all right, Ted. I'll start with you since you answered second. That was a little test. We'll just see how this works out. No, let's start with wheat. Huge numbers. Let me get this right. Ending stocks for Kansas City hard red were the lowest in 5 years. Is that why that market fell off, rebounded, or was it because of strength in corn?
It's a combination of the two. And look at the spread that we've got between Chicago and Kansas City wheat. It's just really, really low, right? So the Kansas City wheat has upside potential if the wheat complex as a whole can continue to have upside potential, but I'm not so sure it did. Look at what the Chicago wheat did on Friday. We had a really nice run out of the gate, ran right into key resistance, and then fell back off and fizzled by the end of the day. That's not really what you want to see in a market that, you want to go higher. The big hope for wheat, in my opinion, is the U.S. dollar, which on Friday took another push to the downside. Looks like it's flirting or thinking about another leg lower. If that happens and we get more competitive on the global market, then the wheat complex as a whole might be in business.
Mark Gold, you said it a couple of weeks when you were with us. You thought the dollar was going to be the big weight on wheat. Do you see that still as the case?
Yeah, I believe the dollar is on its way to somewhere between 89 and 90 cents. I think those are the kind of levels that'll get some more attraction for our export market. And I think overall it can be a little bit friendly. We've got some of the lowest stocks numbers we've had in 5 or 6 years. And there's no reason why this market can't rally, particularly if corn and beans start a nice new uptrend here.
All right, so if they're going up, are you making a sale in wheat right now, Mark?
No, I think we've been pretty low for a while. We're looking for a much better rally than this to sell some more wheat.
Okay, holding off on that. Mark, let's talk about this storm. Both you and Ted and I were talking about it before we started rolling today, just how serious this thing is. Estimates are high. 10 million was one guess. Do you have any idea when we're going to know an acreage number about how serious this is, Mark?
Well, I think it's pretty serious. There was one estimate out today across the Midwest, 37 million acres. I think that's pretty high. But I think we're looking at total corn production losses of somewhere between 300 to 500 million between Iowa, Illinois, and Indiana. I think that makes a big difference. I'm convinced that we have seen the high production numbers that we're going to see in both corn and beans this year. And those derechos, it blew through my apartment on the 38th floor. It almost took off my barbecue and a 80 pound plant. But thank God they were battened down and we were able to get through it. But it was bad.
Ted, the same thing, I guess same question for you. You're about to head out across rural America on a crop tour. That's going to change. You're going to see some of this damage firsthand. What are you hearing about the damage?
Oh, yeah. I mean, we hear a lot. As Mark said, we heard of 37.7 million acres impacted by this storm. My question about that, though, is what do we mean by impacted? Because that's a lot of rain that we got. If we don't have damage in those fields, those are going to produce a little bit better. So, I hear what Mark's saying, between 300 and 500 million bushels of corn lost. Wow. Think about the bushels we got from the areas that needed rain, that got rain out of that system, So I don't know about that. But that's the point. That's why we do the crop tours. That's why we go out in the fields and we take a look at things. We want to see if we've got corn laying down, is it green snap or is it just bent over? If it's just bent over, you're still going to yield. It might not be your best yield, but it might not be too far off. It's just going to be a pain in the quote unquote butt to get in and harvest that. I mean, you're a mile an hour, all the same direction, so on and so forth.
Yeah.
So that's why we do crop tour. I'm very curious to see exactly what we have to see. I think I'm going to agree with Mark. I think we have seen the high watermarks for our corn and soybean production simply because that was as of August 1st, and we've had a lot of things happen as of August 1st. I'm surprised they got as aggressive as they did on soybean yield because that really is dependent on the weather in the month of August. And I look at the forecast, and to me, that doesn't seem ideal. So I see that coming down. And I think the market says the same thing. I mean, look at what happened. We got a really bearish report on soybeans there on Wednesday, and we rallied on that. We rallied on Thursday, ran into the 200-day moving average, which we haven't been over since the duration of the November soybean contract. Yeah, we took a little bit of a step back on Friday, but we look like we're poised to break out to the upside there in soybeans.
All right, Mark, what about what Ted's saying? We did have that bearish report followed by bullish movement in the market. We did give a tiny bit back on Friday. Has the market kind of done its parsing of what the weather report is, or is there something else happening here under the water?
I think there's a lot of things. I think there are a lot of components in this market. I love the fact when a market rallies and closes higher on a bearish report, that was positive. I like to see that. We've got the triple bottom in December corn at 320. We've got the double top in December corn at 363. That's kind of our parameters for the time being. But I'm hopeful that we can move this thing higher. The soybean market has had an enormous amount of Chinese buying. I think it was 7 days in a row now we've had some export sales to China. And I believe that what's happening in Brazil leaves us to be the only real seller available to the Chinese. And regardless of what we see or hear from them, they're going to be buying more beans, and I think ultimately corn and wheat as well.
There was a report late today, Mark, on Reuters saying that the meeting between the Chinese and the United States was off for not exactly the reason. Nobody else has picked up that story. What's that mean when it comes to soybeans?
Well, I saw the report. It came out about 11 o'clock on Reuters. And I'm looking at the market waiting to see it tank. And didn't do a thing. It just kind of rallied a half a cent, broke a penny, rallied a half a cent. It did nothing. Not what you'd expect to see after the announcement, if it's true. I searched a lot of different sources. Reuters was the only one reporting that. But the fact of the matter is, if the meeting is postponed for whatever reasons, it's not necessarily friendly, but it's not necessarily bearish. And when we're looking at these production cuts, I think that's much more of a story. And the continued buying that China's been doing is much more of a story than a 6-month checkup on how we're doing with phase one.
Ted, are these the summer highs, Ted, right now in soybeans?
Are these in soybeans? No, I don't think so. Going back to the Chinese-U.S. meeting and how that affects soybeans, what was this meeting going to be anyways? It was going to be a checkup on the trade deal, right? And look at the incredible, tremendous amount of buying that China has been doing as far as soybeans and just agricultural goods as a whole in the last few weeks. This was going to be a victory lap for both sides, saying, hey, this trade deal is going really very well, and we look to continue it. So yeah, that could have been positive for the market, but I don't think the postponement or cancellation of that meeting, if that's actually what occurred, I don't think that's a negative effect to the market because the proof is in the pudding. And as the sales that we have seen, and I got to say, Paul, I don't think this is the summer highs for the market. I don't think it's the highs for the market, going through fall and winter either, because with the amount of soybeans that China's buying, if they continue to do this, there is a chance that we're going to set a record for soybean exports this year. And the USDA is a long ways away from that on their balance sheet. So take that 610 million bushel carryover that they're using right now. If you do cut out a little bit of production, like Mark and I are both talking about, and you add a significant amount to those exports, we could run out of soybeans this year. That's what the market is now realizing. We're transitioning from a bearish weather market to now a bullish supply or a bullish demand driven market. We might very well look back and say, wow, we sold way too many soybeans to China for sub $9. This was the great Chinese soybean robbery of 2021. That is the concern that I have, that we sell too many beans at too cheap of prices, and we get left out of the mix when we actually do see higher prices. And I think commercials are really worried about that too.
It's like they saw a deal and they knew something was happening because they knew what was afoot in there. We'll discuss more of that in Market Plus. I got to get to livestock because there's a little bit of a optimistic feeling in the live cattle market, Mark. But do you buy sentiment over what fundamentals are telling you or technicals in this market right now? I mean, we've been on a ride up here. Is this a feeling, or is there something underneath?
We rallied 5 days in a row in the cattle market looks pretty darn good. Considering we still have a lot of cattle backlog that we need to work through at the higher weights, but the stock market seems to be keeping this thing together. I've been saying, watch the stock market. You want to know where cattle prices are going. But as a risk manager, we're certainly telling our clients, spend $3 to $4 on a put, protect this thing, let it go where it's going to go. But we've had one heck of a great rally in both the fats and the feeders, and not to protect it out here seems to be a marketing mistake that guys shouldn't make.
Ted, do you see the same thing, same technicals? I'm sorry, the same underlying current playing out in the market? Are you selling right now, live cattle?
First of all, I love that Mark just said buy puts, because that's just one of my favorite things to hear him say. Yeah, look.
What did you expect me to say?
Yeah, right? No, but look, the chart looks good. There's nothing technically saying to me that we need to come in and rush in and sell cattle right now. That being said, when I look out at the December contract trading 113, I wonder if we're going to see cash cattle justify that when we get into the fall and winter months. And I'm a little concerned about that. So I'm with you, Mark. Let's go out and buy some puts and protect some of that downside. I don't know if I'd be aggressive on selling futures quite yet, because technically I don't see anything wrong with the chart. Yes, we've gotten a little overbought. Yes, we could see a little bit of a correction. We are at the top end of this trending channel that we've been in. But fundamentally, yes, I do worry that we have gotten to prices that I think are maybe at or a little bit past fair value out in those deferred months. And I think it's a great time for producers to take some protection.
Ted, you just said something about cattle that also applies to feeders. Which is a better play right now, cash or futures in that market?
Cash or futures in feeder cattle?
Yeah.
Like which do we? Which
one should you be more involved in right now? Playing the futures or selling cash?
Well, again, you like a cattle complex rally where the feeders are the leaders. Now, whether it's the cash market or the futures market, I'm not sure that really matters. I'm worried that the cash market has limited upside potential, and therefore I'm worried that the futures market has limited upside potential. So, let's just put it this way, Paul. I'm not really aggressively buying anything in the cattle complex at this point. I think the vast majority of this move has maybe run its course for the time being. And while we haven't seen anything technically on a chart or even any sustained weakness in the cash market to make you believe that we're going to fall off of a cliff, I just don't see much upside potential from where we're at in the short to near term. I would look for a pullback anywhere, cash or on the board, okay, and then I would be more interested in being long.
Mark, you get the final word on hogs. We went over $54 for a time for a couple of days this week, closed just over 53. Is that the top?
Well, it looks a little toppy, but the fact is I still think the Chinese want pork. The key number is 55. If we can close over 55, then I think we've got an extension of this rally out here. But we need to see some better Chinese buying. We need to see a few things come into line out here. But I think the market, we've tested 40 on the downside. We're testing 55 on the upside. I'm hopeful that we can bust out of 55 and take it maybe up to $70, $75. I think
right.
potential is there.
Mark Gold, thank you very much. Ted Seifert, thank you. We'll talk to you guys at Market Plus.
Thank you.
That will do it for this installment of Market to Market. We will talk more in that program we call Market Plus, so join us there. You can find it on our website at markettomarket.org. Photos are helping tell the story of this week's storm. We've shared many via our Instagram feed of Market to Market Show. We'd appreciate your follow. Next week, we'll look at how one company is helping landowners restore a bit of the prairie. Until then, thanks for watching and have a great week.
Market to Market is a production of Iowa PBS, which is solely responsible for its content.
What's the most complex industry on Earth? It's not genetics, or meteorology, or logistics. It's a business that involves them all. It's farming. Thank you, farmers, from Pioneer.
Sukkot Manufacturing Company, providing equipment and buildings to store and condition grain to help farmers adjust to market swings. We build drying, moving, and storage equipment designed to preserve the quality of their crops. Sukkot Manufacturing, store now, profit later.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.